All right, we'll just give it 5 seconds and we'll kick it off. All right, thank you. Good afternoon, everyone. I'm Scott Roberts, VP of Programs for CFA Society of Atlanta. We would like to welcome you to our sponsor webinar series, Beyond Active and Passive, the Customization of Finance, courtesy of our sponsor, Invesco. We certainly appreciate Invesco's support, and we certainly appreciate all of you for being with us today. Before we hop into today's content, I do want to cover just 3 upcoming events I think many of you will get a great benefit from participating in. Next week, we're going to have a webinar where we're going to get a fascinating update on the state of the U.S. election. And then on October 9th, please join us in person at the beautiful new Invesco Midtown Atlanta headquarters to discuss the compelling case for private real estate credit. And then November 6th, please also join us in person as we celebrate our newest CFA charter holders at our annual conferment dinner. Please go to the website for all the details and the sign-up links. Now, moving to today, we're thrilled to be joined by Ken Blay, who's head of research for global thought leadership at Invesco. In this role, Ken leads the development of original research through collaborations with investment teams, industry researchers, and institutional clients. Also, Dr. Mark Ranganam is an accomplished senior asset management and academic thought leader bridging industry and academia. Mark is the CEO of Compendium, a firm that helps asset managers articulate, position, refine, and communicate their unique investment edge. As a reminder, please use the Q&A feature at the bottom of your screen to submit questions. And with that, I'll turn it over to Ken to get us underway. Thank you.
Scott, thank you very much. And let me just start off by saying, expressing our appreciation to the CFA Society of Atlanta for allowing us to share this research. This is the culmination of many years of work. I mean, it took longer than it probably should have, but it did take some time to kind of think through what we were faced with. Now, just so everybody knows, this is available on the CFA Institute Research Foundation website. We'll provide a link later on, and I understand that they'll be sharing a link on that to the monograph, where there's a lot more detail that can be covered in the monograph than we can cover today. So what we'll be talking about today is, what's likely to happen beyond active and passive investing. And let me move on to the next slide. To give you a sense of kind of the state of the world when we first set off on this research, I'd like to do that through 3 general statements for consideration, not assertions. The first being, passive investing is the right way to invest. Now, you may or may not agree with it. I suspect that most people these days do agree with that. If that is the case, we can look at statement number 2. If passive investing is the right way to invest, then it follows that passive investing will at some point overtake active management as people realize that that's the right way to do things. Now, these 2 things follow from one another. What doesn't follow is this third statement. Investment management will be the only domain where innovation is actively ignored. Now, I know that seems kind of absurd, but at the same time, this was the state of the world when we looked at this, right? So most people were saying that you should invest passively. From an academic perspective, everybody was investing passively. There's this notion that passive is overtaking active management, and yet when we looked at just within Invesco, within the industry, we saw a tremendous amount of innovation. Not only that, there was ML, AI, NLP, ChatGPT, massive data sets. All of these things were coming on board, and it seemed pretty absurd then as to why would we ignore that? Why would investment management be the only place that all of this innovation would be ignored? And in fact, we don't believe it is. But in terms of where we started the journey, this was kind of the conundrum when we first started this. This is kind of the state of the world, and so what we wanted to do in this work is understand why this exists, and where is there something wrong in terms of our understanding of how things are evolving. So our hopes in this presentation today is to take you along the same journey that Mark and I went through, that in many ways challenged a lot of our priors about the evolution of passive investing and active investing. and really opened our eyes up to really a lot more nuance in terms of the evolution of things that ultimately shaped how we viewed the what we saw as the future of investment management. So today we'll go through the beginning of the active versus passive debate. So where did the argument start? We'll look at the historical roots of active and passive funds. Then we can shape some perspectives there, but it's also useful to understand what actually happened. And so part of what we've done in the monograph and what we'll do today is provide an overview of an analysis that we've done in terms of looking at the evolution of active and passive investing from 1989 to 2021, and to get a sense of what's actually happened in the real world. Knowing that, we can then start opining about the future of investment management, and we'll close with a summary of key takeaways from the work. So with that, I'll pass it over to Mark to begin us on our journey in understanding how things have evolved and where things are likely going.
Oh, thanks, Ken. And I'd like to thank everybody who's taken the time to attend today, and thank Kathy and Scott and Kevin Lyman as well for helping arrange set this presentation up. Ever since I was a PhD at the University of Chicago, I've always had in my lexicon the terms active and passive. And the first thing we wanted to do in this research is to understand, when did this actually come into the common nomenclature, or when did it enter the nomenclature, and when did this passive versus active debate begin? So Ken, if we could move to the next slide. Ken and I sort of did research, and we think that the beginning of the active and passive debate really had two roots. One root was from the industry side of the issue. The other was academics. And we actually think that the beginning of the active and passive debate can be dated as 1960, the year 1960. Now, why do we say 1960? Because there were two articles that were published in that year that were spot on in terms of the debate. The first one was an article published in the Financial Analyst Journal entitled "The Case for an Unmanaged Investment Company" by these two authors, Renshaw and Feldstein, who I believe were out at UCLA at the time. And in their research, they asked a very provocative but simple and leading question, which was, would investors be better served by an unmanaged investment company that just tracks some type of representative market average return? And they did research, and they looked at the performance, and their work also cited other work by the Cowles Foundation and other researchers, that found that investment fund performance typically was not superior to that of an average or common stock index, such as the Dow Jones Industrial Average. I mean, we hear this argument all the time. I mean, we see, we see all sorts of, research still today talking about how well the passive index funds do relative to others. So they said, why don't we have what they called an unmanaged index fund as opposed to a managed one, which was a typical mutual fund? Now, interestingly, several months after that was published, there was a retort to this, not surprisingly, entitled "The Case for Mutual Fund Management" by an author whose name was published as J.B. Armstrong, again in the Financial Analyst Journal the same year. And turns out that J.B. Armstrong was the pen name of Bogle, of John Bogle, who very much took on this case about the unmanaged investment company. And he wrote that if you looked at some of the data, that 3 of the 4 pioneer mutual funds with, at that time, 30-year track records had percentage increases greater than those of the Dow Jones Industrial Average. He said that there were numerous implementation challenges to create a portfolio based on an index, based on trading costs, based on, fractional share ownership, a lot of implementation operational challenges. And he said the inflexibility of unmanaged funds makes them undesirable for the average investor who does not have the time or ability to determine the suitability of securities for their particular needs and preferences. it is not without some irony that we found that, 15 years later, that Bogle went on to found Vanguard, because back in 1960, he was making the case, for mutual fund management. That's conventional mutual fund management, which we call active. So we have, in one case, the passive, which is the unmanaged investment company, and the other case, active, which is the case for mutual funds. Can we go to the next slide?
Yeah. Incidentally, in both of these papers, the authors point out that the Dow Jones Industrial Average is not a great index to do this with. They both argued against using the industrial average for that because of the price weighting scheme.
Yep. So we have in the industry saying, why don't you just create something that's sort of like a market average? And then we get into the academia, and the academic theory was beginning to really make substantial advances in the 50s and 60s, building upon Markowitz portfolio theory and the capital asset pricing model of Sharp, Lintner, Trainer, and others in the early 60s, that clarified thinking about both passive and active. And it turns out that the academic framework set up both cases, the case for both. On the passive side, the capital asset pricing model said that all investors would own the same portfolio of risky assets, that is the market portfolio. All investors would only demand and desire one portfolio of risky assets, namely the market. And in the market portfolio, they defined what it is. It's not like the Dow Jones Industrial Average. In the theory, the market portfolio became all assets that are weighted by their market capitalization, these cap-weighted indices. And what happened is then the market portfolio became the standard bearer for passive investing. Okay, that was sort of so the academics, through the fact of the market portfolio being optimal, the one and only portfolio investors needed, became the anchoring point for making the case for passive investing. On the active side of the coin, the capital asset pricing model, on the other hand, led to what was known as the security market line, that is a precise linear relationship between risk as measured by beta and expected returns. And people went out and started to estimate these things so that the average security or portfolio return in excess of the level of beta risk was termed alpha, okay? And alpha, and one of the earliest people that looked at mutual funds and alpha was Michael Jensen back in the 1960s. People also began in academia to look at Sharpe ratios as looking at the risk-return trade-off, at a portfolio level. But most critically, the search for alpha became the hallmark of active investing. So the beginning of the active to passive debate, we had the industry back in 1960, we had the capital asset pricing model in 64. The academic views tended to be more aligned with the passive perspective, at least initially brought access to the practical, but it was still decades away. In 1970, you had Fama with his efficient markets hypothesis that again supported the passive approach, saying because prices are fully reflected all available information. And again, in 68, you had a piece by Jensen that looked a study of 115 mutual funds and could not, on average, find superior risk-adjusted returns or alpha. And furthermore, these funds did not outperform a buy and hold perspective. So the initial academic work supported passive, but then starting in the late 70s and early 80s, you had another stream of research, which was in the anomaly research, and that's when my sort of earlier work began, which led credence to the potential benefits of active management, whether there was something more than beta that mattered. You had early work by Basu that showed you could use price-earnings ratios to potentially outperform these beta risk-adjusted research. You had Bonds and myself in 1981, talk about the size effect. So there was, by the early 80s, there was an academic case as well for the active case. So Ken, let's move on. So here's a very precise, what's the concise history of diversified access to financial markets? So in 1774, there was a broker named Abraham Van Ketwich who solicited subscriptions to a fund called, I'm going to mispronounce this, Endrak Macht, which means unity creates strength. And it was an innovative and pooled investment vehicle that provided diversification and access to opportunities unavailable to most others. So he also, in this time in 1774 in Amsterdam, separated the investment management function from the brokerage function. Van Ketwich took on the investment function. So we had these pooled investment vehicles, okay, these trusts. Interesting, these pooled investment vehicles didn't really appear until the second half of the 19th century, and mostly in closed-end investment trusts in London in the United States. So they were not adopted, these pooled vehicles were not adopted, embraced very quickly. And in fact, a year that was very important in the history here was 1924, when the first open-end mutual fund became the next big innovation. So this was done by the Massachusetts Financial Society Service Company, MFS, question? Okay, which offered a pooled vehicle, and this pooled vehicle offered two things. It not only offered the diversification benefits that Van Ketwich had talked about, but it also offered liquidity. That is, the fund could issue and redeem shares at net asset values. And this did not take off immediately. You know, prior to that time, there were closed-end funds, but by the mid-1940s, the AUM of open-ended funds exceeded those of closed-end funds. So it didn't happen quickly, but certainly within 20 years, open-ended mutual funds, dominated because they were preferable and offered, better, not only diversification, but liquidity. So if we move on to the last slide, where are we today? Well, today, most active and passive funds are in open-ended pooled vehicles, whether they be ETFs or mutual funds. The index fund today, the earliest examples we can find them was one that was trying to be created by Wells Fargo Bank to engineer an index fund, but it was not an SEC registered vehicle. But Bogle had persuaded Vanguard to let him run what was in 1960 called an unmanaged fund. And in 1976, he launched the first index investment trust with $11.3 million in assets. And his objective was to track the S&P 500 index while minimizing investor fees. By 1989, this fund had grown to 1.8 billion, a very substantial growth rate, but still it was only $1.8 billion. And then we had the next evolution in these index funds was another structure that another pooled structure, which was the ETF, which allowed sort of intraday liquidity and perhaps some better tax characteristics. So that's the history of where we were. The passive versus active debate began in 1960. It evolved first from mutual funds, then through ETFs. And now I'll let Ken talk about how this landscape has changed.
Mark, I appreciate that. And as I mentioned previously, I think, so we've got some background, we've got some perspective as to when the debate started. But before opining on where things are going, it is often useful to see and understand where things have come from. And so what we've done in the monograph and what we'll be sharing now is a study that we did on open-end and ETF AUM funds across the globe, looking at AUM from 1989 to 2021. And in this sense, we used Morningstar direct data for open-end and exchange-traded funds. We excluded money market and closed-end funds from these. And we organized the data across three different sets so that we can understand if there's any differences in adoption, any differences in how things have evolved. We've broken them down into US, Europe, and the rest of the world. And what I mean by breaking them up is that where are the funds domiciled? Where are the funds launched? So a U.S. fund could own European stocks, or a European fund can own U.S. stock. But what we looked at it is that the place of domicile. So U.S., Europe, and what we're calling the rest of the world, which is the catch-all for this. That includes everything else, Latin America, some of the APAC region and such. Now, when we look at this in terms of AUM, this is ranked appropriately, where US is the largest and the rest of the world is by far a lot smaller than both US and Europe. So we looked at all legal fund structures, not just 40 Act funds. There's different fund structures across different regions. And we looked at AUM, not flows. And when we spoke to several researchers about this, and their suggestion was, well, look at flows. I mean, that's what you want to know what's going on, what's happening, what decisions are being made. Why not look at flows? And one of the things that Mark and I decided was that, well, flows tell us one thing, but we also want to understand assets under management, or basically that includes information about flows, that includes information about organic growth. But more importantly, it includes information about the decision to stay in the funds that you're in, right? When you look at flows, all you're looking at is, I moved from this fund to this type of fund. When you look at assets under management, you're also looking at, assuming that everything is liquid, the decision for investors to stay in a particular type of fund, right? Assuming that these things are liquid, investors at any given point in time can shift from active to passive or vice versa. And so we thought that looking at flows would be a lot more instructive. And it's also useful in understanding where revenues
looking at
asset
AUM,
management industry are going.
Yeah, looking at AUM.
And for the purpose of the research, we went ahead and used Morningstar's active versus index categorization framework. I mean, this is in a lot of ways to avoid an argument about what is active and what is passive. We just relied on what Morningstar did. And just so we understand, the way that Morningstar categorizes indexing is that they have straight indexes or market cap weighted indexes. And then they have enhanced indexes that fall under this, and that includes smart beta, strategic beta, those types of things. And so in any case, some portion of the indexing that we're going to be looking at within this study is going to include some of these smart beta, or what some people might call active light, or simply actively managed assets. So it might be biased towards indexing. In any case, this is just to avoid disagreements about what is active and what is passive. So let's look at the broad landscape, right? So we can see from 1989 to 2021 that in fact indexing has made substantial inroads. But when we look at the big picture at the end of 2021, we see that indexing, despite these inroads, it was roughly 1/3 of the entire universe. So active management still represented the lion's share of AUM in terms of, across the globe. Now, when we break this down across different types of assets, we can look at active or index versus active in equities. And here we see, I think, what is more generally tied to the common narrative that passive investing is kind of taking over the world. Here we see that it's roughly 50% of AUM, where indexing is taking over 50% of AUM. And my understanding is that since we published this, that there were already several news articles that it already surpassed the 50% mark. Now, it's interesting that we see here. So what this is telling us is, to some extent, that indexing is an equity phenomenon. So just generally speaking, and we can confirm this by looking at the rest of the AUM. And here we see that in things that are not equities, indexing has not gained traction to the extent that it has within equities. And there's a lot of reasons for this, structural reasons. For example, bonds, very difficult to include in an index structure. There's several. Any single company can have several bond issues, any number of different things. But in any case, there hasn't been as much traction gained, even though fixed income is starting. At least we're starting to see fixed income strategies evolve and increase here at least from an indexing perspective. So when we look at the equity world and we look at the composition of how that is broken down, what we've done is we've broken them down across, let's just call them use cases, right? So there's a U.S. equity, global equity, regional equity, and sector equity, and cleanly and neatly here we can see that U.S. equity is roughly, pure U.S. equity is 50%, global equity is 21%, and then like for example, sector equity is 8%. But when you look at the big picture and you would say, well, global equity includes roughly 50% of U.S. equity, there you're starting to see that U.S. equity makes up about 60% of all equity in funds. And then if you assume kind of the same math for sector equities, that's another 4%. So you're looking at about 64% in U.S. equities across, which is a huge number. So let's look at equities and the same breakdown. And let's try to understand what, where within each category, how much of each category is active and how much of it is index. And here what we did is we did this ratio of index AUM to active AUM. And a value of 1 means that it's at parity. So index and active AUM are exactly the same. Values above 1 means that there's more indexing. Below 1 means that there's less indexing. And so when we look at all of these categories, what we find is that the only category or the only group that has more indexing than active is U.S. equity. This was not, I mean, this already started, at least for Mark and I, to kind of change our perception of things. There's this view that passive is evolving, but that it's evolving in a very uniform fashion. Clearly, that's not the case. And we'll see in the next slide, when we look at just that U.S. equity category and say, well, is this a U.S. equity thing? Now, when we break U.S. equities down into much broader categories, and now we look at the same ratio of index AUM to active AUM, we see that the only subcategory where indexing surpasses active is U.S. large cap blend, right? So this takes away the argument of saying, well, it's a U.S. large cap thing. Because you can look at the far right of the screen, U.S. large value and U.S. large growth, those remain firmly in active territory. So those are mostly active funds. So it's something interesting that's going on. So the passive investing, the evolution of passive investing has been happening largely in the U.S. large cap blend space. Now, it's not shown here, but what I will say is even when we look at the subclasses of U.S. small and U.S. mid or U.S. mid, where we're seeing the greatest traction is in these core areas or these blend areas. And that kind of makes sense if you're not looking to participate in the price discovery and you just want to be a price taker. The easiest and cleanest way of doing that is a broad market index. So when we look at large cap blend and look at it across regions, something interesting starts happening at the very least within Europe. Here we look at the dark blue line on the left-hand side. You can see that U.S. large blend was the largest portion of indexing. This is the proportion of equity index AUM, largest proportion of indexing, and that makes sense because back then virtually the only funds that existed or indexed funds were S&P funds. And within roughly starting in 2000, you started to see a lot more innovation, the rolling out of passive sector funds, the rolling out of passive regional funds. And there you start seeing the proportion of indexing kind of reaching what might look like an equilibrium of about 50% of the total indexing in the US is US large cap blend. In Europe, you start seeing that it has made substantial inroads. And there you can see that it's about 20%. Rest of the world, you can see a small uptick at the bottom, but it's still pretty tiny. Now, looking at each one of the regions, we wanted to say, well, how we've broken down things into categories that we thought might be use cases, but what about looking at these things from largest amount of AUM? And so what we did is we took at the end of 2021 the categories with the largest AUM, and then we looked back and measured these ratios over time. And what we see is that the only category again that has exceeded the parity is large cap, US large cap blend, and by a big margin. And so one of the ways of thinking about this number is that for every dollar invested in active, to the far right, there's about three $3.25 invested in indexed products. You do see that there are inroads being made in other areas. I think that's a function of innovation. But what's interesting, U.S. large value and U.S. large cap growth, those still remain pretty low in terms of active versus index. And that's something interesting that we also saw within the monograph, is that it looked like anywhere where information was being applied, investors preferred to have active management, even above and beyond what might be a strategic beta. When we look at Europe, interestingly, here we see kind of the same thing. Global, passive is making some inroads, but where it's made the biggest inroads is in U.S. large cap blend. What we've seen here, and an interesting aspect of what's happening in Europe, is that you say, well, where is, if money is going into indexed large cap blend and indexed, for example, global large cap, where is this money coming from? And ultimately, it's coming from regional funds. So it appears that investors are moving away from these small or country-specific funds or area-specific funds, and they're just investing in, say, U.S. large cap or global large cap, which is an interesting phenomenon. It also points to the fact that there's less home bias within. Home bias is clearly less of a problem within these things today than it might have been back then. In the rest of the world, here, one of the things that was most striking is that as a U.S. citizen, we like to think that we're at the vanguard of everything and that we brought indexing to the world, and in fact, that is not the case. While we invented the index fund within for the S&P 500, Japan was already at parity in 1989, and way above in terms of active across that time period. Sunk down a little after the internet bubble, but then after the global financial crisis, you can see that it's now roughly $9. There's $9 in index funds for every dollar in active funds. This is an interesting conundrum, because most of the arguments that we hear when about passive investing is that you need price discovery to have efficient markets. Well, here we have a market in Japan, and I don't know your perspective of how efficient you believe it is or isn't, but it's 90% indexed, right? So one argument here is that it doesn't take much price discovery to make these things efficient, but it is interesting to note that we already have a market that's mostly indexed. Another thing to recall is that there's individual security holdings that are helping with the price discovery that may not necessarily be found in funds. China is also an interesting story here. It had started to be in terms of mostly indexed, then went to mostly active, and then went back to mostly indexed. But you see that it's reached a plateau, and we see the same information in the U.S. emerging market funds. It started indexing and then it kind of plateaued. So clearly there's a preference in some of these categories for active management, or at least it reaches some point of satiation for active management. And lastly, we want to look at the smart beta category. So this is where we started talking about, there's some portion of indexing that is active light or smart beta or strategic, whatever you want to call it, but that it isn't purely active because it isn't purely indexed because there is some security selection going on, and there is some adjustment to portfolio weights going on. But even in this space, we do see some nice inroads coming in within the indexing aspect of things here. At the tail end there, it's roughly 15% of the total index AUM, strategic beta versus the core beta. But was interesting is that it's been pretty flat for the past roughly 8 to 10 years, right at around the 15% mark. Now, I suspect that since the end of 2021, there's been this has increased as a function of improved performance across certain factors like value that had a long stretch of underperformance. and now the advent of greater ability to index fixed income funds. So I suspect that this is larger today than it has been. But that does provide you kind of a backdrop that, look, this uniform view that passive is taking over the world. There's a lot more nuance to understanding that. It's clearly a U.S. phenomenon. It's clearly a U.S. large cap blend phenomenon, and you could argue that it's clearly a core or a blend strategy phenomenon. But it isn't, anywhere there's a demand for the use of information and security selection, that remains largely in the active management camp. So with that, I'll pass it to Mark to provide us our ultimate perspective on the future of investment management.
Yeah, thanks, Ken. And I know we want to sort of finish in about 10 minutes with the rest of the presentation, so leave time for questions and answers, hopefully. Well, where does this all lead us? Where were we thinking? One, what did we see? One, we saw that indexing was where it become really dominant. The gorilla in the room was in equities, and in particular in U.S. large cap equities. But we saw across the world still, active is by no means dead. We think, looking at the changes moving forward, that there's actually going to be a once in a century shift change. And that's not meant to really be dramatic. I mean, I can, and maybe it is a dramatic statement, but I think the last time we were in such an era was 1924, when mutual funds sort of were introduced into the scene. We think that there's going to be a shift from pooled products to what we call hyper-managed portfolios. Now, the key rationale for index funds, again, this pooled index fund, was that the diversification benefits of an index could not be achieved outside of the pooled investment vehicle because of economies of scale, trading, bookkeeping, etc. So that the gains from pooling exceeded the potential benefits of customization. We think the technology is on the verge and is actually about there to enable low-cost customization. We see this not only in an operational sense, but we see it in the sense of systems to help investors understand and models to understand how investors want to sort of allocate their resources. And we think that this technology, this advance in technology, like it has disrupted so many other industries, will completely change the calculus of using indices, the pooled vehicle, in a pooled vehicle format. The barriers to personalized indexes are dropping even for individual investors. I mean, we've seen a great change in sort of, the decline in trading costs. We see now that fractional share ownership is already being offered. If you want to own an S&P 500 index and own the individual holdings, you can now do that, with several firms. So these barriers that made a pooled vehicle the economically desirable vehicle, that the economics of that are dramatically changing. And at the bottom line is we see the desire for customization and flexibility will diminish the demand for pooled vehicles, especially large-scale ones. I mean, we talked about how indexing, was most popular in these largest scale, large cap blend category. We think that our view, or certainly my view, is that these are the funds that are going to be most susceptible to this disruption caused by this technology. So that you're going to be having, solutions that will be tailored to specific needs and preferences while still maintaining diversification. And you're going to see this intermediation, or what I call the unbundling of pooled funds. This is going to be on the sort of index side. The active side may be more resistant to the shift, reflecting, the fact that active managers may have proprietary insights and unique intellectual property. But as one of Ken's colleagues told us, the bar for active funds may actually be raised even higher as customization becomes more possible, because you can get even a better outcome for most investors with a customized solution. So let's go to the next slide. So where we see this bleeding is what we called hyper management. The reason we chose hyper management as a term is because going back to the beginning in 1960, it was called an unmanaged portfolio. We see it now, the pendulum swinging way the other direction to hyper management, where the capability to implement these highly customized solutions that address multiple investor objectives, not only risk and return, but investment horizon and taxes. We see these hyper managed solutions will move beyond the constraints of pool vehicles, will include the best aspects of both active and passive perspective, and within portfolios, even at non-institutional scales, can include hundreds, even more, of individual securities plus pooled funds. So we see hyper management actually as the future. We're not saying it's going to be tomorrow. I mean, it took years for the open-ended mutual fund to overtake the closed-end fund, but we see this as the way going forward. Yet this has certain challenges. The challenges of hyper-managed separate accounts at scale will require technological advances in operations, fractional shares, custody, bookkeeping, proxy voting, tokenization, etc. Some of this has already happened. And it will require the development of what we call decision support systems to help elicit the preferences and requirement of asset owners and to formulate an optimal investment policy. Finally, these separate accounts will require to have an understanding of the trade-offs in pursuit of solutions that have multiple investing. So if you look at customization, we view customization as a form of active management. It's not necessarily active management in the sense of alpha seeking, that can be part of it, but it's a much more holistic solution. If we can go to the next slide. So what's the implications for asset managers in the future? We think this is a critical one. Large firms will transition from portfolio management as a product. When I was at Oppenheimer and State Street, we were basically portfolio managers. They were basically creating products. We're going to go from portfolio managed as a product to portfolio managed as a service that offers a totally integrated solution. We still believe that investment teams that create proprietary, well-articulated active products will have a seat at the table. We think that asset managers are probably going to be in the best position to take on this challenge of hyper management. Because there's such an operational requirement, institutional consultants may have trouble sort of scaling up beyond just making recommendations at sort of a higher level. There's going to be the needs for the higher level, for the more granular recommendations, and whether the institutional consultants have the implementation capabilities is yet to be seen. Custodial banks clearly have the implementation capabilities, but we think for regulatory reasons they won't necessarily want to expand this because of their regulatory and capital requirements. Plus, custodial banks may not have the reputations as sort of the most leading edge sort of investment thinkers. So we think that asset managers actually are going to be a key player and a potential key beneficiary of this move to hyper management, and that on the other hand, asset managers are going to need to develop metrics to demonstrate to their clients the net economic benefit of the customized investment process. It's going to move well beyond, let me look at your 1, 3, and 5-year track records, because those pooled vehicle track records are not going to be so relevant. And as a last implication for asset management industry, the human resources teams at these companies will need to reassess the optimal mix of employee skills and backgrounds. So I've taken too long, Ken, so please.
No, that's fine. I think we got a little bit of time to go through what we hope will be the key takeaways from this research. The first one is in looking at the evolution of active and passive investing empirically. It is the case that active is still, there's still greater amount of AUM in active than passive. That's across all asset classes and across all domiciles, even though passive has made notable market share gains. When we think about this perception about passive overtaking active management, that's a function largely of what we see in the U.S. large cap blend category, although it is happening in other places, but to a much lesser extent. And just what was, I think, interesting for me was that this kind of eye-opening part was that it's not been adopted uniformly. Passive investing has not been adopted uniformly across asset classes, categories, or regions. Like I said, that when information about security selection or portfolio management is required, investors still prefer active management to passive or even systematic strategies, which is quite interesting. So what does this mean for investors? What I'll say here is it's a big jump to say that from that point of view, innovation and investment management is not dead. But the reason I have that point there is to say that part of the reason that passive has been so successful is that it is offered, just like Abraham Van Ketwich did, is a broadly diversified investment and at an increasingly low cost, right? So I think in a lot of ways, asset managers have gotten a bad rap in the sense as that they've actually produced they've invested heavily to produce these vehicles that can offer you this massive diversification at one basis point, which is largely unheard of. There's a lot of innovation that has gone into that. If you think that tracking a paper portfolio with no trading costs and trying to track the returns of that in the real world is not an active endeavor, then you probably need to think a little bit more, because it is quite active. There's a lot of time, effort, research that goes into actually producing what we call passive investment vehicles. So as these advances in trading and so forth have evolved, that means that we're going to get to these hyper-managed solutions. This evolution has led to the ability to get to other places. So the other thing I want to point out here is that alongside all of the trading that has occurred during this time period, we've gone from indexing to direct indexing, where institutions can have their own custom index with their own investment strategies that can use regimes, they can use factors, they can use any different number of things, ESG, all these types of things. There's a lot of infrastructure and a lot of know-how now that is in place that will allow or foster the ability to develop these hyper-managed solutions. And that is where we're going to see this disintermediation of pooled products, right? The example I'll give here is think about a tax-managed S&P index fund. So certainly it is tracking an S&P index, but I would argue that tax management is a highly active endeavor. And so when you think about something like that, which would be in some senses a hyper-managed solution, is that active or is that passive? The point here is I don't think that's relevant. I think at the end of the day, an investor is getting an exposure to, say, the S&P 500 with active tax management that meets the desired needs. And this is what we're saying, that these hyper-managed solutions, we're going to incorporate the best of both worlds, both passive and active elements. Second of all, the customization of asset management. In a lot of ways, this is the next frontier for asset managers. We started, asset managers back in the day started with pooling. We're now at the other end, where the next evolution of things is actually depooling. And in some sense, the next step is investment management without the constraints of pooled vehicles. Now, it doesn't mean that everything is going to be depooled. It has to make sense to do that. But that's where we are. And like Mark said, we're just at the beginning of this. It's going to take a lot of investment in infrastructure, a lot of investment in the personnel required to do these things to move this forward. To follow up on Mark's point, differentiation through customization, you got to move. It's going to require asset managers to move beyond selling on a fact sheet, a 1, 3, and 5 year track record. It's going to mean that they have to stand out in terms of their investment capabilities, their asset management capabilities, their trading resources, technology resources. They have to stand out as somebody who is trustworthy and is innovating in the field, and somebody who can collaborate. So there's a lot that needs to happen if this is going to occur. And I know that asset managers are right now in the process of investing heavily to make these things happen. Across the board, what this means for investors is that just greater access to customization, greater access to personalization. For financial advisors, as this evolves, it's going to mean that they're going to have to engage more closely with investors, but they're also going to have to engage more closely with asset managers to work together to create the solutions that ultimately benefit the end investor. And that's where asset management as a service comes in, right? And as asset management firms to move to or transition to offering asset management as a service, they're going to need to develop tools and have the human resources in place to deepen and expand and have more constructive relationships with advisors. This goes to the decision support system. I know when my time at State Street, when we developed a strategy with an institutional investor, that we would iterate back and forth. We would go, it's like, we want to do this, and this. We would sit down in front of MATLAB or in front of Python or whatever, and create a strategy. We would then have a meeting with the investor, review it. It's like, let's change this, change that. Come back, redo the work, present it again. And sometimes those iterations took 2 to 3 months. That's not going to work. What is going to be needed is these decision support systems that allow advisors to sit down with their clients and create the tools that they need, or create the strategies that they need, showing and allowing them to show their investors, the trade-offs, understand the trade-offs between the preferences they have with the risk and return objectives that they have as well. And what I'll say here is that this will be the era of the extroverted quant, and I think that's it may sound like an oxymoron, but you do need people with deep understanding of finances, economics, and quantitative investing that can make those concepts easy to understand, so as to keep those relationships in place and explain why or why not tactfully you might want to do something. And so those types of individuals are going to command a premium at asset management firms, and even investors, even financial advisors would benefit from getting a deeper understanding of quantitative investing and all of these types of things. And that's where I think the CFA program does a wonderful job in providing a deeper understanding of investment management. But all in all, what will end up happening across the value chain is that there's going to have to be more constructive relationships, deeper relationships. And I think largely this is a positive because it means that we're going to have solutions that are much better aligned to investor needs at the end of the day. So let's close out going back to those 3 general statements. So when we look now at passive investing is the right way to invest, look, it is a way of investing. It's not going to go away. We don't believe it's going away. Passive investing will overtake active management. I think it'll be a part of actively managed portfolios. Like I said, that's not going away. It's a very reasonable way to invest. But they'll be subsumed, both active and passive approaches will be subsumed into these hyper-managed solutions. And this last statement, investment management will be the only domain where innovation is actively ignored. I think we can squarely say that that's incorrect. And in fact, the opposite is correct, where I know just in speaking with asset management firms that there is heavy investment in being able to move to this next this next evolution in asset management, where customization will be at the forefront. So with that, I'll close and see if there's any questions or questions that anybody would like to make.
There's one question. Can we go back to slide 23? I think that's about the Japanese market. I think this question has 2 parts. I want to make sure that's the right slide. Yeah, okay. So the question is, this change, pretty substantial change since 2015, was that retail driven or institutional driven? And are there any implications for the US market?
In Japan?
Yes. Is there a lesson here, I think is what this question's getting at. Is this one-off? Because clearly this is a standout.
Right. When both Mark and I, because we were scratching our heads on this, but what we've found out since is that the market in Japan is heavily directed by banks, So a lot of what is being directed is by sophisticated investors, which tend to have a preference for passive investing. And there may be other reasons, but I think that's the best reason I know Mark and I have gotten for that. And I don't know, Mark, if you have any thoughts on that as well.
Well, I think there's two things that sort of struck us. I'm not sure that I can account for sort of the meteoric ascent of indexing, but what's clearly struck us is that different regions and different investors in different regions have different viewpoints about this, and so it's really hard to make a generalization. I mean, we know that some active managers would say, well, how much more
Passive can be
more
taken.
indexing can there be?
Yeah.
And the answer is, because in the US there's about in the large cap blend categories, these numbers are between 3 and 4. And Japan says, well, it can go higher still, potentially. But to me, this suggests difference. It may suggest sort of the risk preferences. There just can be sort of cultural differences. And these are predominantly Japanese domiciled firms with that are focused on Japanese investments. Scott, were there any other?
We've got one more coming in. Let me read this. The question is, do you foresee these structural shifts in passive benefiting larger firms exclusively, or do smaller firms and new innovators stand to benefit as well?
I see this as, go ahead, Ken, do you want to take it first?
No, go ahead. I mean, I have some thoughts, because there's a lot to this there's a lot to this question.
Yeah, there's a lot. And I don't know that it could be very disruptive. I mean, a large firm that has a large passive index business, particularly focused on US large cap blend category, could be disruptive. So I think that there's a lot of opportunity for smaller firms to come in and develop these customized approaches. Okay, so I think there's a lot of opportunity. So I see this as a disruptive event. I don't see this as an event where a large firm is necessarily going to be an advantage, because it's these large firms can be like ocean liners, and they may not be as nimble and agile as required. I mean, we've seen this time and time again. I mean, just recently, right? You see, Intel, which was once a market leader, is now sort of struggling. So I don't think size doesn't mean necessarily security or success. Ken, what were you gonna think?
Well, so I might take a slightly different tack at that. I mean, I think one of the things, so the infrastructure that's going to be required to be able to do these things effectively, and provide reporting and provide servicing and provide, that's not going to be an inexpensive endeavor. There's going to be a lot of investment that's going to be required. That said, it's also the case that many of the innovations that we're seeing in both in AI, ChatGPT, and even the data sets that are being used today are not inexpensive. And so access to those resources that I think we're also going to be driving innovation within this space. It's going to be much harder for smaller firms to be able to get that. That said, it's also the case that even if you have access to these data resources, you need deep expertise, right? So it's not just one person that can understand, for example, NLP data. You have to somebody that understands what was in there, how is it, is it clean, is it not clean, can it be used, what can it be used for, what can it not be? There's a lot of expertise that goes into implementing a lot of these concepts that may or may not be within the realm of these smaller firms. Now, what I'll say is that there are going to be niches where these smaller firms are going to be able to be a lot more agile and advance things in a way that may not happen in these large firms. Now, ultimately, that might mean that those firms get bought out, which is positive or negative depending on your perspective of things.
Okay, excellent. Last call. I think that we're right at the top of the hour. I don't see any further questions. So Ken and Mark, thank you very much. This was outstanding. And thank you for all those that dialed in. We'll send out a replay and event survey shortly. So thank you all very much.
Thank you, Scott, and thank you, everybody, for your time
And
today.
if they can, if you want to just, I think Kathy put the link into the chat, please go and you
Sure,
can
thank
download
you.
the monograph. Thank you, Kathy.
Thanks, gentlemen. Bye-bye.
Thanks all.